Good morning and welcome to the post-MPC press briefing. The Monetary Policy Committee of the Central Bank of Kenya met yesterday, June the 9th, 2026. And so today, June the 10th, 2026, as we usually do, we have the Governor of the Central Bank of Kenya, who's also the chair of the MPC, who will give us an insight into the MPC's thinking, some of the data, and obviously the decision and what's behind that decision. After that, you're free to come in with your questions. And if you want to do that, you can go to Slido, www.slido.com. The meeting identity is hashtag MPC0626. Please make sure you include your name and institution as you ask a question. And as we said there, we may combine some of your questions if they're asking about the same issue. But without further ado, I'd like to introduce and welcome the chair of the Monetary Policy Committee, who's also the Governor of the Central Bank of Kenya, Dr. Kamau Thugge.
So good morning, everyone, and once again, welcome to this post-MPC press briefing. So the MPC met yesterday on June the 9th, 2026, and decided to maintain the central bank rate, the CBR, at 8.75%. The MPC observed that the conflict in the Middle East has disrupted global supply chains and led to a sharp increase in energy prices and transportation costs, and this has resulted in higher inflation and moderated global growth prospects. Kenya's overall inflation is expected to remain within the target range in the near term, assuming a de-escalation of the conflict in the Middle East. And this will be supported by appropriate monetary policy actions, government interventions, including subsidies and temporary reduction of VAT on fuel, expected stability in food prices due to favorable weather conditions, and a stable exchange rate. Central banks in the major economies have remained cautious and kept their policy rates unchanged as they continue to assess the impact of the conflict in the Middle East on their inflation as well as growth outlooks. The average lending rates of commercial banks in the domestic market have declined further, while private sector credit growth has continued to improve. Having considered these developments, including the potentially transitory nature of the conflict, the MPC concluded that the current monetary policy stance, with a central bank rate unchanged at 8.75%, remains appropriate to ensure that inflation expectations remain anchored within the target range and that the exchange rate also remains stable. The MPC will continue monitoring the evolution of global oil prices and any second-round effects on inflation, as well as other developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in August of 2026. Starting with developments on the global front, the global inflation is expected to increase in 2026 to 4.4%, up from the previous projection of 3.8%, and this reflects the higher energy prices attributed to this conflict in the Middle East. And because of this higher inflation, the central banks in the major economies have remained cautious and kept their policy rates unchanged as they continue to assess the impact of the conflict in the Middle East on both their inflation and growth outlooks. In regard to inflation in major economies, these inflation rates have increased and remained above their respective targets in the recent months, and this is due to elevated energy prices and stickiness in core inflation. So headline inflation for the US, the Eurozone, and China, you can see there on the left-hand side, they have increased, whereas the UK headline inflation has declined, partly as a result of lower electricity and gas prices. The core inflation for the US, Euro, and also the UK also has declined because of the reasons I just gave. But these high and sticky core inflation rates have continued to contribute to the higher headline inflation. And these now higher core inflation rates are being supported by higher global commodity prices, including on food and oil prices. In the case of food, food inflation increased modestly in May of 2026, driven by high inflation rates for edible oils and also for cereals prices. In the case of the international oil prices, these have remained elevated and volatile since March 2026 due to supply disruptions and elevated uncertainties attributed to the conflict in the Middle East. The outlook for the international oil prices remains uncertain and is predicated on the length and severity of the conflict in the Middle East. Turning to global economic growth outlook, the global growth is projected to moderate to 3.1% in 2026 from 3.4% in 2025 due to the effects of the higher inflation and reduced demand. So as I said, the global growth reduces from 3.4 last year of 2025 to 3.1, but then picks up to 3.2% in 2027. For those countries of relevance to us, the United States growth actually goes up between 2025 and 2026, which is good for the certainly good for our it's a positive for our economy. The UK has contracted quite sharply from a growth of 1.3% to 0.8% this year, but recovers in 2027. And similarly, for the euro area, we see a revision and a contraction from 1.4% in 2025 to 1.1% in 2026, and then an expansion in 2027. On the global financial conditions, these have tightened due to elevated global uncertainties, but the global equity markets rallied in both April and May in 2026, while Eurobond yields for some emerging markets and developing economies, including Kenya, have eased slightly on account of improved investor sentiment. So to summarize on the global developments, the global inflation is projected to increase in 2026, largely due to the higher energy prices. The central banks in the major economies have remained cautious and kept their policy rates unchanged as they continue to assess the impact of the conflict on inflation and growth. Global growth is projected to moderate in 2026 on account of higher inflation and reduced demand, again attributed to the higher energy prices and elevated uncertainty. Global financial conditions have remained tight, but equity prices have recently rallied, while Eurobond yields for some EMDs have eased slightly on improved investor confidence, and EMDs, Eurobond issuance, have moderated. Risk to the global growth outlook remains elevated due to the evolving conflict in the Middle East, elevated trade policy uncertainty, the ongoing Russia-Ukraine conflict, and weaker global demand. And finally, Kenya's growth is expected to remain above the global, the emerging markets, developing economies, and the sub-Saharan Africa growth averages, mainly reflecting the resilience and the diversified nature of the Kenyan economy. So turning to domestic economic developments and outlook, and starting with inflation, the overall inflation has remained within the target range since July of 2023, but increased in April and May of this year on account of higher energy prices, again reflecting the elevated global oil prices. And indeed, the overall inflation over the last 2 years, since about mid-2024, has actually been below the 5% midpoint of our target range. So overall inflation rose from 5.6% to 6.7% between April and May, and this was due to higher energy prices, again arising from higher global oil prices. But it still has remained within our target range of 5 plus or minus 2.5%. But indeed, the increase in overall inflation was contributed to by both the core inflation, which rose from 2.8 to 3.2%, and also the non-core inflation, which increased from 13.4 to 16%. In regard to the main drivers of core inflation, which increased to 3.2, this was driven by the transport items, and in particular, city bus and matatu fares, and again reflecting just higher fuel prices. Now, the processed food inflation remained relatively stable, supported by lower prices of sugar and maize products. And just looking at the composition or the contribution of the various items in the core inflation, one can see that primarily the increase in the core inflation is purely as a result of the increase in transport items. And you can see that the transport items have increased from 0.7 in April of 2026 to 1.1. That is a 0.4% increase, which also is reflected in the 0.4% increase of the core inflation from 2.8 to 3.2%. In regard to the non-core inflation, this increased in May, and this was on account again of higher energy prices, and in particular fuel and gas prices. But in addition to that, the food prices also increased, and especially the tomatoes and cabbages, and also the transport component of the non-core inflation also increased, and its composition or contribution to the core non-core inflation increased from 1.2 to 1.6 percentage points between April and May. So the overall inflation is expected to remain within the target range in the near term, and this projection assumes a de-escalation of the conflict in the Middle East, and this projection is also supported by assuming an appropriate monetary policy actions, the government interventions including subsidies and the temporary reduction of VAT on fuel, the expected stability in food prices due to favorable weather conditions, and a stable exchange rate. And we expect, therefore, that with the de-escalation, that the highest that the overall rate of inflation will reach will be about 7.2% in around February of 2027, which is still below the upper end of our target range of 7.5%. Looking at inflation expectations in the private sector, the May 2026 MPC Market Perceptions Survey and Agricultural Sector Survey show that some upward pressure is expected on inflation in the near term due to higher energy prices, but inflation expectations remain anchored within the target range of 5 plus or minus 2.5 percentage points. In the case of the agricultural sector survey, a majority of respondents to the May 2026 agricultural survey, that is a majority, 64%, expect some upward pressure on inflation in the near term, mainly due to the higher energy prices, and 36% expect a decline or an unchanged position on inflation. But this is, although there is a majority that expect an increase, you can see that compared to the survey that was done in April, there is actually a significant reduction in the percentage of respondents that expect an increase from 81% in April to 64%. And equally important to note is that the number or the percentage of respondents that expect a decline or inflation to remain unchanged has increased from 19% in April to 36%. Nevertheless, even though they expect an increase in prices, the respondents expect inflation to remain within the target range in the near term and supported by stable food prices and also the stability in the exchange rate. Turning to the market perceptions survey, the survey shows that, and this includes both the banks and the non-banks, the survey shows the respondents expect some upward pressure on inflation in the near term due to effects of higher oil prices. However, inflation expectations remain within the target range, mainly due to the expected lower food prices and the stable exchange rate. So to summarize on developments and outlook for the rate of inflation, the overall inflation increased to 6.7% from 5.6% in April, mainly driven by high energy prices and transport costs, but still remains within the target range of 5 plus or minus 2.5%. The overall inflation is expected to remain within the target range in the near term, assuming a de-escalation of the conflict in the Middle East, and remaining within this target will be supported by the appropriate monetary policy actions, the government intervention, including subsidies and a reduction in the VAT on fuel, and expected stability in food prices and in the exchange rate. The May 2026 MPC surveys show that inflation is expected to increase in the near term, but inflation expectations remain anchored within the target range of 5 plus minus 2.5%. The main risks to the inflation outlook relate to heightened geopolitical risks, particularly the conflict in the Middle East, which has resulted in volatility in global oil prices, and also the elevated trade policy uncertainty. Turning to the GDP growth developments and the outlook, the growth of the economy is projected now at 4.9% in 2026, compared to our previous projection of 5.3%. And this revision downward mainly reflects the continued uncertainty and implications of the conflict in the Middle East on the performance of some key sectors of the economy. The high energy prices are expected to affect the performance of sectors such as the manufacturing, transport and storage, accommodation, and food services, and wholesale and retail trade. The disruptions in supply chain are expected to affect exports and imports of goods and services. However, the agricultural sector growth is expected to improve both in 2026 and in 2027, and this growth will be supported by favorable weather conditions. In regard to the industrial sector, it is expected to remain resilient, driven largely by construction and affordable housing program with the settlement of pending bills and public-private partnerships. The key service sectors are expected to remain resilient, supported by continued digitalization of the economy and the expansion of e-commerce. And finally, improved uptake of credit across key sectors is expected to support growth, particularly in trade, building and construction, agriculture, and consumer durables. So again, going to the bottom of the panel there, that you can see the real GDP growth, and you can see the deceleration from 2024 was 4.7, came down to 4.6 last year, and now we expect it to go to 4.9. And as I said, of course, this is a revision downward from 5.3, taking into account the global economic developments. So growth in the credit to key sectors of the economy, you can see there for in the case of the building and construction, trade, consumer durables and agriculture, there is significant credit from the banks going to those particular sectors. In the case of the manufacturing sector, there was net loan repayments in both April and May, which explains the contraction in credit to the manufacturing sector in both of those months. It's expected that this will recover in the coming months. So looking again at the surveys, this time in regards to the CEOs and the market perception survey, these surveys reveal sustained optimism about economic business activity and economic growth prospects for the next 12 months relative to estimated growth in 2025. In particular, in the case of the banks, 71% of the respondents were optimistic about growth prospects for the next 12 months. And only 29% were pessimistic about growth. Nonetheless, this is the previous survey of March had indicated much stronger optimism for growth at 87%, and those who are pessimistic were much less at 13%. In the case of the non-bank private firms, again, a majority of 61% were optimistic about growth prospects, and 36% were somewhat pessimistic. And again, this is compared to the previous survey. The percent of those who are optimistic is less. That is 70% compared with 61%, and those who are pessimistic have increased from 23% to 36%. For the CEO survey, for the May survey, 35% expect lower GDP growth, 40% expect same growth, and 25% expect higher growth. And the optimism was attributed to expected favorable weather conditions, which are expected to support the agricultural sector. There's also increased infrastructure spending and increased digital innovations, a stable exchange rate, and improved private sector credit growth. Nevertheless, the optimism was moderated by concerns about increased global uncertainties attributed again to the conflict in the Middle East, the high cost of doing business, inflationary pressures, and low consumer demand. So to summarize on the domestic economic growth prospects, the growth of the economy did moderate in 2025 to 4.6% from 4.7% the previous year. And this slowdown reflected a slowdown in agriculture and services sector, both. But growth in the industrial sector did recover strongly, and this was supported by the expansion in the construction sector. The leading indicators of economic activity point to resilient performance in the first quarter of this year. The growth of the economy is projected at 4.9% in 2026 compared to the previous projection of 5.3%. The MPC surveys that were conducted in May revealed sustained optimism about business activity and economic growth prospects for the next 12 months. But the optimism was moderated by concerns about the elevated global risks. And this outlook is subject to risk, particularly a prolonged conflict in the Middle East, in the Russia-Ukraine conflict, and continued elevated trade policy uncertainties. Turning to monetary developments, this is our monetary policy implementation framework. This framework has continued to support the stability of the Kenya shilling overnight interbank average, and this Kesonia has now been aligned and is aligned very closely now to the CBR, and this alignment should enhance monetary policy transmission. And as you can see, even in the last few months, that Kesonia is actually very close to the CBR, and as of June 2026, you can see that the CBR rate was at 8.75, and the interbank rate, the Kesonia, was also at the same level, 8.75. Short-term interest rates and commercial banks' lending rates have declined in line with the recent reductions in the central bank rate. The treasury bill rates have increased recently, partly reflecting market correction and alignment with the monetary policy stance. In the case of the, on the right-hand panel, the case of the commercial bank interest rates, these have continued to decline from a peak of 17.2% to 14.5% in May 2026. And this has stimulated credit demand from the private sector, as we will see shortly. This is the our yield curve, which continues to exhibit a normal upward slope. And of course, as I just mentioned, yields at the short end have adjusted upwards recently, reflecting this market correction and alignment with the monetary policy stance. In regard to the broad money supply, this has remained quite strong in May of 2026 by increasing from 10.3% in April to 11.8% in May, and this increase has been driven by growth in the domestic credit. Both credit from the private sector but also net lending to the government have contributed to this expansion of M3. In addition, the contribution of net foreign assets, and especially the accumulation of reserves by the central bank, have also contributed to an increase, to an expansion in the money supply. So growth in commercial banks lending to the private sector improved sharply in May to 9.3%, and this was supported by increased credit flows to key sectors of the economy, as we saw a few minutes earlier. And this is the risk-based credit pricing model, which was fully implemented in March of 2026, and is expected to improve the transmission of monetary policy decisions and enhance transparency in loan pricing. So to summarize on monetary developments, the Kesonia the operational target for monetary policy has continued to closely track the central bank rate. Short-term interest rates have declined in line with recent reductions in the CBR, but Treasury bill rates have adjusted upwards. The commercial bank's average lending interest rates declined in April and May of 2026, and growth in money supply, M3, improved in May of 2026, reflecting increased domestic credit and net foreign assets accumulation by the central bank. And growth in credit to the private sector continued to improve and stood at 9.3% in May of 2026 compared to 7.1% in April of 2026 and compared to minus 2.9% in January of 2025. And growth in credit to key sectors of the economy remained strong. Turning to the balance of payments, a wider current account deficit is projected for 2026 due to the impact of the conflict in the Middle East. But the deficit is expected to be more than fully financed by financial and capital account inflows. For 2026, we are projecting a current account deficit of about $4.3 billion, and for 2027, a slightly higher amount of $4.47 billion. On the other hand, the financial and capital account, we are projecting a surplus of $5.2 billion in 2026 and $4.88 billion in 2027. And the result of this is that this year we'll have an overall balance of payments surplus of $865 million and $414 million in 2027. And this will help us to continue to build our international reserves position. As I said, the current account deficit is projected to widen from 2.1% in 2025 to 3% this year, again reflecting developments in the Middle East. We expect lower exports growth and as well as the primary income account, both lower exports and higher interest payments, net interest payments. We also expect a higher oil import bill due to higher oil prices. We expect lower receipts from the services sector due to increased freight payments. We expect also slower growth in remittance inflows both from the Gulf states and also from third-party countries, and finally the indirect impact via Kenya's trading partners and reduced global demand. Turning to total goods exported, for the 12 months to April, we saw an increase in exports by 4.2%. We are projecting, being very cautious and estimating only an increase in exports by 2.3% for the year as a whole, 2026, before a recovery in 2027. In the case of goods imports, these increased by 8.5% for the 12 months to April. And as I said earlier, this is driven by food imports, intermediate and capital goods, and also mineral fuels, the higher oil bill. And as a result, we expect that imports will increase by about 8.1% in 2026 before slowing down to 7.2% in 2027. In the cases of services sector, the service receipts increased by 4.8% for the 12 months to April of this year. But tourism is doing very well, and therefore we expect for the year as a whole for the services export receipts to increase by 8.9%. As I said earlier, the tourism arrivals have remained resilient. And as you can see, for the first 3 months of this year, we had arrivals increasing by almost 12%. And then for the year, as the 12 months up to March, we saw an increase of 8.7% in arrivals, and we are projecting an increase of arrivals of 7%. In the case of diaspora remittances, they remained resilient in the 12 months, increasing by 1.1%. In the first 4 months, they've increased by 1%. And again, reflecting that slow pickup in remittances, we are projecting an increase of only 1.5% for this year. The CBK's foreign exchange reserves have increased and continue to provide adequate cover and buffer against the short-term shocks. And as you can see, between 2025, we've seen an increase from $12.39 billion to the 8th of June of 13.2, and that is equivalent to 5.6 months of import cover. Regarding the exchange rate, despite this heightened geopolitical risks, the Kenyan shilling has remained stable, and this has been supported by diversified foreign exchange inflows, confidence in the economy, and adequate foreign exchange reserves. To summarize the balance of payments developments, the current account deficit is estimated at 2.6% of GDP in the 12 months to April of this year. And this is compared to 1.7% of GDP in the same period of last year. For this year, the current account deficit is projected to widen to 3.3% of GDP, compared to 2.1% in the previous year. And this widening of the current account reflects the effects of the conflict in the Middle East, including the higher international oil prices, lower receipts from services, and slower growth in remittance inflows, and reduced growth of exports. The current account deficit is expected to be more than fully financed by financial and capital account inflows in 2026 and also in 2027, and this will result in overall balance of payment surpluses for both years. So gross foreign exchange reserves are projected at $13.2 billion at the end of 2026 from $12.3 billion in 2025. The downside risk to the balance of payments outlook: a prolonged conflict in the Middle East, which would exacerbate commodity price disruption. There's also the continuing elevated trade policy uncertainties and volatility in the international oil market. Turning to the banking sector developments, the banking sector remains stable and resilient. The capital adequacy and liquidity ratios for the banking sector have remained above the minimum statutory limits of 14.5% and 20% respectively. In the case of the capital adequacy ratio, it stands at 20.4% in April, and this is again compared with the 14.5 statutory limit. And in the case of the liquidity ratio, it stands at 61.8% in April of 2026, against the minimum statutory limit of 20%. The ratio of gross non-performing loans to gross loans stood at 15.3% in May of 2026, and this is down from 15.6% in February and 17.6% in August of 2025. Banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, providing sufficient buffers. The revised banking sector risk-based credit pricing model was fully implemented in March of 2026 and is expected to enhance transparency in the pricing of loans by commercial banks and to improve transmission of monetary policy decisions to lending rates. On fiscal developments, the government's planned fiscal consolidation strategy is expected to reduce debt vulnerabilities over the medium term. The supplementary budget that was submitted to Parliament had a deficit of 6.4%, and the plan by government was to reduce that fiscal deficit towards 3% over the next 5 years. So the summary and key takeaways, starting with the global front, inflation is projected to increase in 2026, mainly on account of the higher energy prices. In regard to growth, economic growth is projected to moderate in 2026 on account of higher inflation and reduced aggregate demand, and global financial conditions have tightened due to elevated uncertainties. On the domestic front, overall inflation is expected to remain within the target range in the near term, assuming a de-escalation of the conflict in the Middle East. The exchange rate is expected to remain stable. Economic growth has been revised downwards on account of the elevated global risks. The average commercial banks' lending rates have declined, which has continued to support growth in credit to the private sector. The monetary policy implementation framework has enhanced policy transmission and aligned the Kesonia closer to the CBR. The banking sector remains stable and resilient, and confidence in the economy remains strong, as reflected in sustained optimism in the economic prospects by respondents to the MPC surveys. And in view of these developments, including the potentially transitory nature of the conflict in the Middle East, the MPC has kept the central bank rate unchanged at 8.75% to ensure that inflation expectations remain well anchored within the target range and that the exchange rate also remains stable. The MPC will continue monitoring the evolution of global oil prices and any second round effects on inflation, as well as other developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. Thank you very much.
Thank you, Governor. And so, as we usually do, we jump straight into the questions. These are submitted by yourselves, mostly to do with the decision of the MPC and one or two related issues around that. So we begin, in this case, with Kefa Moirore from the Nation Media Group. Kefa's question is on the Iran war. So he asks, after how long might you consider the Iran war to no longer be transitory and warrant a tighter policy stance? Is inflation printing higher than 7.5%? Anna Wakesa has got a related question, which is, with the CBI held at 8.75%, has the Central Bank of Kenya signaled that the rate cycle has peaked, or is further tightening still possible? And Felix Ochieng from the Trading Room asks, if headline inflation breaches 7% in the coming months, what specific conditions would trigger a rate hike? could we see this at the next MPC meeting in August?
Yeah, I think, of course, as I've said before, our decisions on whether to tighten or even ease monetary policy is based on the data that we receive during the Monetary Policy Committee meeting. So it's very difficult to say at this stage what will happen. We'll have to wait and see developments. We have to wait and see what happens with food prices. The surveys, certainly from the agricultural sector survey, suggest that food inflation may decelerate. It's also maybe the case that these hostilities cease very quickly. So I think at this point it's difficult to say. We are keeping an eye on developments, certainly with regard to the oil prices, but also in regard to the second round effects. And we'll wait to see by the next time we meet what has happened to inflation. And it's on the basis of that that we will take action in the next meeting of the MPC.
So the next batch of questions is beginning with Julian Zamboko from, again, from the Nation Media Group from NTV. Has disbursement of the World Bank's emergency financing begun? If yes, how much so far? David Herbling from Bloomberg News. How do you see the Finance Bill 2026 proposals affecting inflation in the near and medium term? And for this batch, finally, Kevin Rotich from Capital FM. Could you please update us on the plans to regulate mobile money transaction fees in order to make them more affordable for everyone, and when can we expect this?
Let me start with the first question. Julian, I think we are actually in the process of discussing with the World Bank, as you know, on the DPO, and we hope that the DPO will go to the board of the World Bank for discussion fairly shortly. Similarly, there hasn't been any disbursements regarding the emergency financing. That has not started yet, but of course it's an ongoing discussion. But we hope also that will be finalized quite shortly. On the finance bill, we have looked at what is in the finance bill, and we actually don't see much inflation coming from what has been proposed in the finance bill. So, yeah, we don't see an impact on inflation coming from the finance bill. So maybe I can go to the next batch of questions.
Last set of questions will begin again with Paris Moshiri from Madam Economist. Private sector credit growth and monetary transmission. Are we progressing as forecasted with the risk-based credit pricing model in place versus external shocks? And then finally, Kefa, back to Kefa Merori, and also Anna Wekesa of the Kenya Times are asking actually the same question. A few banks are still working to meet the 3 billion shilling core capital rule. Has CBK granted a grace window to these lenders to conclude pending processes? Anna asks the same question. Has CBK issued any grace period or any grace window for banks that have not yet met the 3 billion shilling core capital requirement?
Yeah, let me start with Paris Moshiri. I think certainly since the risk-based credit pricing model came into place, we haven't, as the MPC has not changed the CBI. It has been paused. The change has been paused for the last 2 meetings of the MPC. So it's difficult to tell you what that new framework would have had on the credit to the private sector. But having said that, I think the easing of monetary policy that we undertook before the pausing, you can see that it has had a fairly positive impact. We've seen TBO rates have declined quite significantly. We also saw in the presentation the decline in commercial bank lending rates from 17.2% to now 14.5%. And obviously the intention of the lowering the CBR was to stimulate credit to the private sector. And indeed, we have also now seen that the lending by banks to the private sector has moved from minus 2.9 in January of 2025 to 9.3% in May of 2026. So yes, I think the new framework, once an action is taken either to tighten or to ease, would be, in my view, would be very effective, because it will have an immediate impact on lending rates by commercial banks, either increasing or decreasing. So no, we haven't offered any grace periods for banks to meet the core capital requirement of the 3 billion. Excuse me. Some of them are indeed. There's a few banks, maybe about 3. Some of them are going to issue some additional. Their shareholders are going to contribute to meet the capital requirement, and we've also had some indications from and support from the National Treasury in case of one of the banks. So there is no grace period, and of course now we expect that the banks will also meet the capital requirement for the 5 billion this year. And we are engaging all those banks that have less than 5 billion to see how exactly how they are going to meet that capital requirement.
So that brings us to the end of this briefing. Thank you very much, Governor. So as we usually say in the MPC press release, the MPC is planning to meet again in August, that's in 2 months, but stands ready to take any action where the circumstances to warrant it. So for now, we leave it at that, and we will see you the next time the MPC meets, which for now, as we said, is scheduled for August 2026. Thank you very much, and do have yourselves a good afternoon.